Cardinal Health has attracted the attention of activist investors as they have largely been falling behind their peers. And so that actually caused the stock price to recently surge. But the question is it the right time to buy the security? I'm going to do a full valuation and dive into this opportunity. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money. Let's get it. What's up, guys? And I want to show you exactly what's happening here. So you can see here that as of the recording of this video, Cardinal Health's share price absolutely ran up. And the reason why the share price ran up so much is because Cardinal Health's CEO just stepped down. So Mike Kaufman actually stepped down. Now, I don't think he was a bad CEO. He led the company recently through the supply chain issues, and most notably, he helped the company reach those opioid settlements. And so just as a reminder, he became the CEO in 2018 when the company was struggling slightly and they were facing a wave of civil litigations, which caused them to be distracted in terms of their overall strategy. Now, remember, guys, from the Cardinal Health series that I did put out previously, I guess maybe a year ago now, they did agree to pay a total amount of $19.5 billion over 18 years to resolve those class actions. So that's largely behind them now, and you can actually discount that $19.5 billion, which is what I did in the model. But activist investors have been looking at Cardinal Health as recently as this year, and they're saying that, look, man, we could unlock some real value with this company. And really what they're talking about here is something that I didn't go deep into talking about in the Cardinal Health 3-part series that I put out, which was that they weren't really focusing in on the higher margin medical supplies business. I did notice that when I was doing the research, but the share price was so low at the time that it didn't even matter if they made inroads into that business because they were so profitable just with their regular business. And the Wall Street Journal was pretty scathing to them. You can see that they said that a failing oligopoly takes serious mismanagement. And so effectively, they're taking shots at the executive management there. And they're saying that that's why it turned itself into an activist target. And notice on the comment below, they did say exactly what I was talking about. They say, investors say Cardinal Health has made poor investments and mismanagement missteps in its medical supplies business. Obviously, that's what they're going after because McKesson has done really well with their medical supplies business. This is a faster growing business with higher margins. So of course you would want to focus in on it. And it's not like Cardinal Health wasn't focusing in on it. They were just not as successful as their peers. And so in this article, the Wall Street Journal does say that Cardinal Health's profitability did drop in the past 5 years, but I do have to point out that the reason why their profitability dropped off is because their peers were investing in these higher margin businesses. And the article goes on to say that a major gripe is that Cardinal Health has made poor investments and management missteps in the medical supply business that delivers such things as medical gowns. Investors would actually prefer that Cardinal focus on the delivery of specialty medications, including cancer injections. Now, once again, I did point my position here. I like that they focused on the medical supply business, and I expected them to focus more on specialty, but the slow pace is obviously understandably infuriating to investors, so I get it. So in comes the activist investor. So this is Elliott Management. They have nominated 5 directors to the company's board a couple of weeks ago as of the recording of this video, which is what prompted their CEO to step down. And just a little bit more details here. Elliott nominated 5 directors to the 11-person board, and Cardinal abruptly replaced their chief executive officers. Activists have been circling Cardinal Health this year with an eye towards whether management change could help boost the company's share price. Now, I do believe that it's very hard to turn this company around. It's going to take time, and that's why I felt very comfortable with Cardinal Health's current management structure. And so the fact that their CEO stepped down, that's a big loss in terms of experience to the company. So let's hope that they can navigate without their CEO at the helm. And some people actually met the move of their CEO stepping down with some skepticism. And analysts asked on the earnings call why the company didn't run a full search, because what ended up happening is that the CFO just took over the CEO position. Now, that's the story up until now. Elliott has not stated what their intentions are, but obviously it's pretty clear that they want this company shooken up and turned around. And I do believe that they will force change, or already seeing them force change with the CEO stepping down. Now, I do have a full model and evaluation on Cardinal Health. But before I get into that, I do want to remind you guys that approximately 80% of the watch time on this channel is from people that are not subscribed. So if you can, please hit that red subscribe button and hit that notification bell to be notified when I upload new videos. Now let's dive into their valuation. Now, despite the run up in the share price to $69, I do believe that it's still not expensive. Now, I wouldn't mind getting it for under $50 per share. You guys might recall that last year I was buying it around this price. I actually wheeled this stock. And for those of you guys who don't know, what wheeling is you sell a cash secured put, and if you get exercised on that cash secured put, which I did, you obviously keep the premium, but then you can actually turn around, and now that because you have ownership of the stock, you can turn around and sell covered calls until you get exercised on those covered calls. So it actually ended up being a pretty lucrative wheel for me. I think it was around 25 to 30% total annualized yield that I generated on that. Of course, that's taxable. And so it did end up working well. If Cardinal Health does come back down to $50 or under, I will consider purchasing it again. Its competitors have skyrocketed, so I've largely left the field. I consider this part of the dividend paying part of the portfolio, and there are other opportunities right now that are better suited for that dividend component of my portfolio. Now, if you want access to the Cardinal Health model and all the other models that the Patreons get access to, you can access that model at the lower tier of the Patreons. And if you want to join us for an awesome call every month, you can join us at the upper tier of the Patreon. Now, if you missed out on that video with Cardinal Health, because I did record that video when the channel was much smaller than it currently is, I actually linked the whole series, which you can get to right here.